and welcome to the EisnerAmper Engaging Alternatives podcast series. I'm your host, Elana Margulies-Snyderman, and with me today is Mayank Mohan, Managing Partner at Museum Mile Funds, an investment manager focused on innovative cash management strategies. Today, Mayank will share with us his outlook for investing in his space, including the greatest opportunities, challenges, and more. Before we dive into the conversation with Mayank, don't forget to hit that like button and subscribe to EisnerAmper wherever you listen to your podcasts. And you can also find us on YouTube at EisnerAmper. Hi, Mayank. Thank you so much for being with me today.
Thanks for having me, Elana.
Absolutely. So to kick off the conversation, tell us a little about yourself and how you got to where you are today.
Sure, absolutely. So I've been in the business around 20 years or so, most of which have been spent within some of the largest bulge bracket investment banks. I started my career actually at Merrill Lynch, which then morphed into Bank of America. And then I was at UBS and MUFG in progressively senior roles, but all generally within the realm of equity derivatives trading. And then over the years within equity derivatives, my focus shifted more to the financing side of the business. And anybody who's been a practitioner within the financing side, which is the so-called Delta One trading desks at these large investment banks, knows very well that the equity financing rate, which is the rate of interest that is embedded inside any equity derivative, trades at a very consistent premium to the equivalent maturity Treasury bill. And again, this is a phenomena that has been very well researched. There are papers on it. It's part of academic texts, including a paper by the New York Fed as well. So this is all fairly well known and not something that we discovered. But banks are using these concepts in order to put on the most optimal hedge to client trades. So that's really how banks use those concepts, because banks are really in the business of facilitating these client trades. Banks are not asset managers, but there is a use case for this to be used by asset managers for yield enhancement. And that kind of ties in to the rest of my career journey. So back there, after all these banks, as luck would have it, I moved to one of the biggest asset managers, and I saw that they were sitting on a very huge pile of cash, which was all invested in Treasury bills. And my immediate reaction based on my years of training was that, hey, we can certainly do better, which led to a spirited discussion, the conclusion of which was that, hey, what you're saying actually makes sense. Clearly, we are leaving money on the table, but this is not core to our business. Our core strategies are something else. And so do we really need to do this? Or is there an off-the-shelf investable product that would do this for us instead, which we could outsource to? And when I looked, there was none. And so that's really what set me thinking, what made me aware of the dichotomy of access and know-how and focus between the sell-side banks and the buy-side asset managers. And I spent the next 5 years just researching this topic, doing a very deep dive into it, spoke with a lot of people, and then finally launched our firm last year to essentially plug that gap and make this accessible. The issue essentially is that asset managers are very focused, and rightfully, I think, on their core strategies and on chasing those 20% or 50% returns, and they simply don't have the bandwidth to monetize the last 50 bips or 1% or in some cases 5% of financing efficiencies. And that's exactly where we step in. So what we provide is simple but unique. So for the risk profile that is similar to Treasury bills, we provide very consistently higher returns, and we do this while maintaining extremely high institutional level daily liquidity, which means billions of dollars of daily liquidity, and we do this for an extremely low fee structure.
At EisnerAmper, we are creative problem solvers that take a 360-degree approach focusing on you. We're an award-winning firm with decades of experience. EisnerAmper. Let's get you ready.
Mayank, I loved hearing your journey. That segues nicely into the follow-up question for you. Given your investment focus on innovative cash management strategies, I would love to hear your overall outlook for the space.
Yeah, sure, absolutely. Some of what we are dealing with here is just inefficiencies in what is otherwise, I think, broadly a very efficient market. And we see those inefficiencies dwindling over time. And let me talk further about what that means. Well, traditionally, if we think about cash management and the tools that are available to invest your cash in a safe and for the short term, then we think about treasury bills or money market funds or perhaps bank deposits and maybe some highly rated commercial paper. And then if an investor really wants yields in excess of any of these traditional investments, then one needs to compromise on one or more of the trifecta of credit risk, duration, or liquidity. And for example, instead of investing in 3-month treasury bills, one could invest in 3-month BBB rated commercial paper. That would get a slightly higher yield, but then one is introducing credit risk within the portfolio, and it is possible that the issuer of the CP gets into trouble, which would be a risk event. Similarly, on the duration front, assuming an upward sloping yield curve in normal markets, instead of investing in 1-month treasury bills, one could invest in 2-year treasury bills and again, get a higher yield. But then that would be accompanied with an introduction of duration risk within the portfolio. And so, that can materialize if interest rates were to go higher. And that could lead to a negative P&L event within the portfolio. So those were the traditional mechanisms by which one could get a slightly higher yield. But what we provide is something unique in that one doesn't need to compromise on any of those factors and yet get that higher yield. And I think the concept of a free lunch within investments is, one needs to be skeptical about it, and it is extremely rare, but it can exist. For example, diversification is a very widely accepted free lunch in that one can actually have a lower risk profile in a portfolio, but a higher expected return through diversification. And we think what we are providing is somewhat similar in that respect, in that for a risk profile similar to treasury bills, our strategies are able to provide a consistently higher return. And again, this is not, this has been extensively studied. There is a paper, in fact, by the Federal Reserve Bank of New York, which actually says that the yield of one of the strategies that we offer is the actual risk-free rate. And it says that treasury bills trade at a discount to that risk-free rate. And it calls the difference between the two as the convenience yield. And that exists because it's just so much more convenient to buy treasury bills rather than having the know-how and making all the effort to harvest the equity financing rate. So what we are doing here is democratizing access to that convenience yield, so to say, and making it easier to access that and making it available, frankly, to the wider market rather than it being simply accessible to a very small group of large financial institutions. So over time, we do expect the markets to become more efficient, as I said earlier, and we expect institutions to increase their adoption of these kind of solutions.
And Mayank, more specifically, what are some of the greatest opportunities you see in your space and why?
Sure, yeah. I mean, the greatest opportunity is the fact that the $6.5 trillion of treasury bills outstanding. So that's an extremely huge target addressable market. So that sounds like a great opportunity. Now, of course, our strategies cannot quite absorb $6.5 trillion, but they can absorb tens of billions. So they do have depth. And so that still is an extremely big opportunity for us. Now, who are the holders of these treasury bills? Well, as a percentage of AUM, some of the large holders are, say, managed futures funds, futures investors. These entities, they do need to carry a lot of treasury bills or cash deposits as initial margin for their futures positions. And then you've got other types of entities like long-short funds, especially the market-neutral ones where their net position is zero and hence they have a fair amount of cash. So those are some in terms of percentage of AUM. But then in terms of just the overall dollar amount, you've got all these traditional asset managers like pension funds, insurance companies, endowments, foundations, family offices, all of those. So the opportunity is really wide and varied, and that's something we're really excited about.
Mayank, on the other hand, what are some of the greatest challenges you face in your investment space and why?
I guess as with any unique and disruptive strategy, there is a healthy dose of skepticism that we are sometimes looked at. And so there is the education component, which is something that takes time, but it's also something that gives a lot of satisfaction. And so, one anecdote that comes to mind is the one call that I had with a potential investor where, after explaining our strategies to him, he had this puzzled reaction and just quipped that, hey, you are asking me to invest in futures and in equities, and you're saying that my portfolio will have minimal risk. And coming to think of it, that's actually exactly what we were saying. Now, albeit with the rider that the futures or the derivatives and the equities would perfectly hedge each other out, and hence there would be no net equity exposure. But that's the kind of situation that we encounter on a fairly frequent basis. So we do believe that the markets are efficient, and finally capital will flow through to the strategies that are providing the highest returns for any level of risk. That is the reason that we've become one of the fastest growing emerging managers, and so within a short period of time we've had the considerable success which gives us a lot of confidence. The education part does take time, but we are in here for the long haul.
Mayank, we've covered a lot of ground today and wanted to see if you have any final thoughts you would like to share with us.
So to recap, I'll just talk about the use cases for our strategies. So, the first use case that we have talked about to an extent, which is cash management, and so we provide just higher yielding cash management strategies while retaining the risk profile of treasury bills and extremely high liquidity and very low fee. But then we've got a couple more use cases. So the second one of which is exchange margin optimization. And what that means is that you've got investors in exchange traded derivatives, namely futures and options, who need to post initial margin to the exchange. Now, we can actually make their margin postings more efficient and optimize those. Again, 99% of those postings are in the form of treasury bills or cash deposits, and we've got a solution that's simply more efficient. So, leaving a lot more and materially more returns for these investors. The third use case I'll mention is collateralized term borrowing. So far we've talked about investments and getting a slightly higher yield on investments. Now we can actually flip that concept around and actually use the same strategies inverted in order to borrow money from the market. And so again, the rate at which we can borrow is typically lower than what your typical prime broker might offer, and it's also locked in for the term rather than being on an overnight basis, which is typical with prime brokerage financing. And then the fourth and final use case that I want to talk about is just yield enhancement. So, this is the case where, all right, you don't have any excess cash. may not even be a futures investor, so none of the above apply. You just have these securities which are marginable. Think stocks, bonds, mutual funds. These are all marginable securities. And so, without changing your investment in these marginable securities, it is possible to actually monetize the marginability of these securities and eke out just consistently higher returns. So those are the primary 4 use cases. As I said before, we've got a lot of work to do. We've got a $6.5 trillion market to address, and so that's a lot of hard work, and we are extremely excited to go to work at it.
Mayank, I wanted to thank you so much for sharing your perspective with our listeners.
Thank you, Elana. Thanks for having me.
And thank you for listening to the EisnerAmper podcast series. Visit EisnerAmper.com for more information on this and a host of other topics. And join us for our next EisnerAmper podcast when we get down to business.